Our next panel discussion will cover the subject China's Belt and Road Initiative implications on the self-insurance industry in Malaysia. This session will be moderated by Kelvin Wu, the Group Assistant General Manager, Risk Management and Insurance, International SOS and Treasurer and member of the Exco of Parima. Kelvin is currently the Corporate Risk Manager of International SOS, where he manages the global insurance portfolio. Joining him in the panel will be Raymond Cheung, the General Manager, International Department, Jiang Insurance Brokers China. Shiwei Jin, Global Program and Captive Regional Director, Asia XL Catlin. Edward Wu, Managing Director, Captive and Mutual Practice, Willis Towers Watson, China. And Dr. Yimin Chen, the Senior Vice President and Head of the China Client Services, Marsh, Singapore. Ladies and gentlemen, please welcome them with a round of applause.
Right, so good afternoon, everyone. My name is Kelvin, and thanks for the introduction. I'm the Risk Manager for International SOS, and I'm also the Board Member for Parima. Very delighted to be here to moderate this session this afternoon. And I come here in the capacity as a client, because I think what has been interesting is from the topics this morning, a lot of interesting discussions about captive, about its implications, a lot of representatives from the insurers, the brokers, the regulators. I haven't yet heard a client being on the stage to offer the comment, and I think the last I checked, the captive only happens when a client decides to set up a captive, right? So I think it will be good to have a client to be part of the panel, which is why, as Parima, we are also very happy to be supporting this in terms of promoting risk managers and our involvement, because I also saw the research done by Richard about the lack of awareness of captives being one of the challenges to the whole industry overall, and I think risk managers play a big part in leading that awareness part as well. Right, so that's a bit of background for that. In terms of the topic for today, we are going to talk a little bit about the China's Belt and Road Initiative. Now, since President Xi announced this grand initiative, 5 years ago now, in 2013, we have seen some gaudy statistics being bandied around, right? So it's supposed to involve 65 countries or 75, depending on what's the latest thing that you read. What is undeniable is that in the last 5 years, you have seen about 50 plus SOEs leading over hundreds of billions of investments in infrastructure across the world, mostly in the region, and that is what is happening on the ground. So people have likened the Belt and Road Initiative, for the history geeks, they have likened it to the Marshall Plan. For those of you who are fans of World War II, that's the plan that was used to rejuvenate Europe in a post-World War II setting. They have likened it to the new growth vehicle for China in view of the lagging growth expected domestically. I myself see it as just a big, giant commercial, marketing narrative that is helping to shape what they were going to do anyway, which is Chinese investments in a lot of foreign national territories all around the world. Right, so this is the backdrop and setting that we have today, and I'm delighted to have an esteemed panel with me today. So I have Shiwei from XL Catlin, who is representing the international insurer point of view. I have my colleague Raymond from Jiang, who is representing a local Chinese broker taking care of SOE clients and how he sees the challenges from their end. I have Yiming from Marsh, who looks after a lot of the Chinese outbound clients in terms of supporting their ventures overseas. And then last but not least, I have Edward from Willis Towers Watson, who is our residential captive expert of the captive scene in China. Right, so that's the panel, and so without much further ado, I'm going to actually start ladies first and pick on Shiwei a little bit. So from XL Catlin's point of view, can you share a little bit with me what are some of the latest insights, findings that you have been seeing from the Belt and Road Initiative based on your exposures with the global programs and captive at XL Catlin? Or should I say AXA XL now? Is it the right time yet or no?
Not yet.
Not yet. All right, so XL Catlin, right, okay, yeah.
The deal hasn't closed yet.
Okay.
So, well, thank you, Kelvin, for the introduction. And on Belt and Road Initiative, I think this is I'm invited to provide insurer view on how our industry, especially how our clients, would see the evolving risk involved in this. There are a lot of discussions and analysis ever since the announcement of Belt and Road. All the risks involved, such as regulatory, operational, economic and financials, etc. So I wouldn't go into that details because also some of the panelists will share some of the insight as they have done wonderful research on that. From my side, I want to just draw on two parts. One is on the changing risk landscape. And on that, I would start with one thing first. The thing that to me to realize is we talk about this, and it's what's shocking is the size, the sheer size of this initiative. China is going to do that anyway. However, they put together this Belt and Road initiative so that everything is more under this umbrella. But look at the umbrella, the countries involved, the people involved, the markets involved. The size is phenomenal. And also, it's not just today. It's in the next 20, 30 years. So what's now multiplied by all these times space, the change is even more phenomenal. And look at these 65 markets or 75 markets nowadays. It's very diversified in the way of not just the social and economic development, but also the cultural and religious background. So that's the first backdrop. And then if we look at that, the second thing to realize is all the risks involved. And this slide shows some analysis from, or some thinking, hopefully to provide, that is from a product availability perspective. So we know that, okay, this Belt and Road, a lot of infrastructure projects, so that could make the traditional products more in demand. And that's not something new. But what's new is the scale of that kind of projects in the countries that such projects haven't done before, and also the complexity, and also what's locally, the interest group. In the past, what type of claimants you are going to deal with. Now, what type of different parties, stakeholders. You have Chinese government agencies, you have local government agencies, you have multinational organizations, and in addition to that, you will have local interest group, which will also have an impact on this whole insurance background. So this is very important to bear in mind, although it's traditional products, but it will be required the risk engineering, underwriting, and claim service to a new level, which wasn't being requested before. And if you look at the new products, or a bit more niche products, such as a kidnap and ransom, terrorism, political risk, credit and bond, and environmental, so on and so forth, those is in more and more the participants will need to be aware, not only just know that we need to get this insurance, but what exactly coverage do you need as a client, what kind of a wording certainty you will want. So it is to seek a solution which is right for you with clarity and certainty. So although it's not just this buzzword, but it's what actually entails. So from a crisis management perspective, in this Belt and Road initiative, it's particularly relevant as you will see the physical damages and also business interruption, the revenue you are going to lose, and also, more importantly, for the company, it's your people asset also involved. You are sending manufacturing and also construction crews and also hire locally. So there will be this people asset aspects into this as well. And this is not just insurance products anymore, because what you also need is the services around this. This including the crisis management services as well as a media response. Because to a company and also to a local economy involved in this Belt and Road, quite a few of those projects and also local investments are very high profile. If something takes place, either due to political reason or environmental pollution, etc., how to manage the reputational risk is crucial. So you will also need that media response as well as those crisis management services as well. And the second part I want to note is it's the time. I mentioned in the beginning, the Belt and Road is now and in the next at least 20 or 30 years. So what we need to look at from an industry as well as from a client perspective is we need to focus not just now, but also on what the risk would evolve. So these are the products now available. What's the changing dynamics when it comes to the overall economic change and also the regulatory and the legal system change, how that would evolve. What applicable today, will that address my risk in future? So time is a very interesting perspective. We need to always bear in mind when we look either participants in this Belt and Road initiatives, or we are operating locally, and some projects will have impact on our economic activities. The next part I want to touch upon very briefly is the local knowledge, because especially from a captive perspective, if you want to have some of the risk seed back to your captive side, and that local knowledge really matters. As you can see, this list, there are 65 countries involved according to their official website. And all these countries, they are having regulatory changes from insurance as well as tax and other aspects. Just a few examples. For example, the risk exportability. So in 2017, 2018, we witnessed the changes in major economies such as Russia and India that require the usage of the national reinsurer. And in Myanmar this year, they implement this retention. So that's on the Myanmar insurance side. So what you would be able to cede back to the captive will be impacted. And in addition to that, there are also cash before cover, premium settlement arrangements. So those would have an impact on your contract certainty as well. Not to mention, each local countries have their own filing requirements. So if you want to have a particular wording, particular coverage tailored for your needs, is that available locally? In order to implement that, what kind of procedure you will need to take? What stakeholders you need to influence? So all of this you will need to be very much aware of. And that comes to my final point. So to Belt and Road, I see this is very much a partnership. To address the risks and also the opportunities, we need to work closely with the local insurer, the international insurers, also the alternative risk solutions, brokers, and also utilize this kind of arena to discuss what's the potential risk, what are changing, so that we can be very much aware of what's now and what would happen in the future. And then we can be fully prepared.
Right. Thank you, Shiwei. And I think just to pick out a couple of points that you mentioned, so you firstly mentioned the scale, and just for comparison's sake, where people have likened the China Belt and Road Initiative to the Marshall Plan that I mentioned, the World War II rejuvenation and so on. The Marshall Plan valued in today's dollars is 1/12 of the overall budget that is being planned for the Belt and Road Initiative, right? So you're talking about some crazy numbers. I don't even know how many zeros. You're talking about 11 trillion. They're estimating 2 to 3 trillion of investment every year. So to give you for context, the Asia Infrastructure Bank that the China backed has only 100 billion, which is a lot of money, but it's barely a drop in the ocean in terms of the amount of investment that is being set aside to fund this project. So that's the first point when it comes to scale. And I think the second part that you mentioned is a lot of the local considerations. You have the list of countries here. Put aside the Belt and Road stuff, and I think a lot of the considerations you mentioned are things that you would have done looking at the risk financing of a project to begin with. But now just because of the sheer number of actors and countries being involved, it changes the dynamics slightly, but I don't think it changes the fundamentals of how you would have structured the risk financing program to begin with in terms of working with insurers and all that. What does change slightly, I guess, is because of the state actors being involved, and then you have to consider the political implications of structuring your program around that, and not the risk financing itself per se, right? So that's the first part. Next, I'm going to jump to at the end of the scale for Edward. So we obviously have this whole session that is crafted around captive. How can captive being involved? What have you seen based on the captive activity in China in terms of how SOEs are involving captives? What kind of projects are they funding? How are captives typically be involved in these sort of projects?
Okay, thanks. Good afternoon, ladies and gentlemen. Probably first of all, I would like to give some introduction about the statistics from last seminar in Beijing. What the risks and the challenge those SOE faced. And in 2017, WTW, Willis Southwestern, Raymond, along with the SASI, held a seminar in Beijing inviting some SOE to attend the seminar. We got the statistics from the seminar. We found the top 7 risks they face. They are, this is 7 risks, including the legal regulation, public relationship, operation risks, talent shortage, personnel safety, culture difference, public risks, among which 3 of them are the top risks and the challenges they faced, including political risks, personnel safety, and enterprise operation risks. Probably we can get a different result from different channels, but at least we can hear what the challenges they are now faced from this seminar. From this seminar, we understand that actually for those companies who make investment along the country, in the country along the Belt and Road Initiative, they have some experience how to manage the risks, and they would like to find some solutions to help them to transferring these risks. Yes, they have these kinds of the solution, including self-insurance method, and they also have found some ways, such as consulting third party, to give them some solution how to manage the risk in the country along the Belt and Road Initiative. From other side, that our local government also would like to find some guideline that can help those companies who would like to make investment in the country along Belt and Road routes to help to do some risk management. And because different industry have different specific risks, they also would like to understand their specific, what the specifics are. So in this seminar, they also talking about the captive. They think captive is one efficient way to help them to transfer or management their risks. Oh, sorry. As you know, in China, there are only 7 captive established in mainland China or Hong Kong, all of them owned by large SOE. So you can see that those captive, their main task or then the mission to establish the captive is help them to manage the overseas risks. So Willis Wilson is actually all of the 7 captive are all Willis Wilson client. We work very close with them and help them to find solutions how to use their captive to manage the risks in the for the projects along the countries along the Belt Road Initiative. So we have some observation during daily work with them. So I already listed some observations here. I would like to share with you. First of all, I found that those captives have very strong motivation to participate in projects along the Belt Road Initiative countries. I have some number for that. You know, CNPC captive so far, they have extended the overseas business around 18 countries with about 28 projects, among which there are 8 beyond the road initiative countries with 18 projects. Similarly, like Sinopec captive also have covered about 92% of overseas insurable business of Sinopec. So you can see they have a deeply involved this project, not just only for business development concern, but also to help to do some risk management of the parents. And it takes very short time, to just take about 2 and 3 years to get a big achievement. So this is very good, but particular, comparably, the Chinese insurer cannot follow the step very fast. So this is why it's very good tools for captive to manage their overseas risk for their parents. The second is that the Chinese captive always treat them as taking the role of insurance management of the group. So the way that they use the insurance integration is a very good way for captive to manage their beyond role initiative insurance and risk. So we can see all of the captive already established their package, we said package, to manage their risk overseas, particularly for the project along the beyond the role initiative countries. For example, for some large oil company captive, they have established energy package, marine cargo package, and some shipping company established health and the machinery package. Before they integrate the insurance, all of the insurance will be placed by the local subsidiary, by which the group cannot understand the risk very well, cannot get the data efficiently, and so they cannot manage those risks very well. But by the captive, they can do that, and also can do some cost saving. So this is also a very good improvement. The third is also very good risk management tool, because the captive can integrate the internal or external resource to provide some risk prevention or risk control issue. I can give examples like China Railway, a captive, they have a very flag project called Laos and China Railway, and the captive already integrate those resources to provide the risk management for the project and give lots of very constructive recommendations for those projects. I think it's very helpful for the group.
So Edward, the advantages that you mentioned in terms of utilizing the captive is not new. I mean, it's commonly cited as the advantages in terms of using captive in general. It's good risk management, it's cost savings, it's premium saving. From your perspective, what has been the biggest challenge for China SOEs to be convinced that captive should be part of this consideration when they are thinking of funding? Because when you look at the funding for overseas projects, there's no lack of money in China. In fact, the primary concern in terms of funding for all this initiative is that there's too much Chinese money funding this sort of projects. What's stopping from the Chinese companies from using the captives more aggressively? Or not, as in
actually, I think they not involve so much about funding the risk, actually. Actually, they must focus on now just for the existing projects. Probably next week, you can consider about this solution, how to use the capital to do that.
Yeah, so at this point, it's fair to say the maturity is probably still quite low in terms of using it as a primary sort of. Okay. So so like I mentioned, like when we talk about the infrastructure projects associated with this initiative, you cannot ignore the underlying political considerations that come with it, right? So like I mentioned, a lot of the concerns when you mention Belt and Road Initiative, they've been talking about what they call debt traps. They've been talking about how China are trying to create vessel states. It's interesting because China is not part of the OECD, so they are not hampered by the limit that OECD imposes on its member nation in terms of how much you can lend to countries, right? And the effect of that is Chinese companies fronted by SOEs are lending prodigious amounts of money to a lot of emerging countries that might struggle to replace the loan, to repay the loan, right? And I see this in a place that I quite like to visit for a holiday, which is Sri Lanka. So I've been to Sri Lanka twice in the last 10 years or so about 5 years apart. And the second time I go to Sri Lanka, I see a stark difference from the first time I went there. Firstly, just by the sheer explosion of the number of Chinese people you see in Sri Lanka. And secondly, by the sheer explosion of the number of infrastructure projects in Sri Lanka that is being worked on by Chinese workers. And if you're in Sri Lanka and you see a bunch of Chinese, they stand out, right? So that's very obvious. And then obviously, when I was there, the whole conversation there was about how the Sri Lankan government, in partnership with a Chinese company, was building one of the key ports. They struggled to repay off the loan, and they negotiated a payment in kind, which resulted in a 99-year lease of the port back to China. So they essentially own the port now, right? So it's interesting whichever way you look at it, right? And that is something you cannot, so this is a question now I'm going to pose to Imi, because we were having this chat when we were preparing for the panel. Like, if you are a client, risk manager, private sector participating in a project like this, you cannot ignore this. It's there. What can you do to manage this? And I know you also have some experiences closer to home as well, because somewhere in Malaysia, we are also talking about the railway link, where you have a lot of Chinese companies involved in the construction of key infrastructure projects in the country as well. Yiming?
Thank you, Kevin. First of all, thank the organizer invite me to attend this conference. And also, most importantly, thank you for coming back after lunch with or without ice cream. You all made it. Thank you so much. And to answer your question, I think Edward already mentioned for the Belt and Road, political risk rank #1. And you mentioned the Sri Lanka port, because they borrow so much money from Chinese government, so now they signed 99 years lease agreement with China Merchant Group.
Yep.
And actually, I want to share some of the key takeaway from our last conference in Singapore regarding the Belt and Road Insurance Summit. A few things. Everybody knows the Belt and Road, but do you know 4 countries are not part of the Belt and Road Initiative, namely India, Japan, Australia, and the United States, right? And secondly, during our 2 days conference in Singapore, we talk about what is the opportunity for international insurance company, international broker. We all know the Belt and Road Initiative will benefit Chinese banks, Chinese underwriter, Chinese reinsurer, but what's the benefit for international player? So we find out, according to the China Re presentation, there are 4 lines of insurance. The Chinese treaty is excluded, namely delayed startup, kidnap ransom, terrorism, and lastly but not least, political risk cover. Yeah, probably I just stop here. So our fellow panelists can also come.
Right, no, like just continuing on that point, right? So we mentioned the example for Sri Lanka. Now, if we shift the example back to where we are today in Malaysia, so I mentioned the East Coast Rail Link, which is a project under consideration. Yiming and we were chatting about another project where a significant Chinese company was buying energy assets that was being owned by 1MDB. Right, and obviously the political considerations of that exposure. And can you share a little bit, Yiming, from what you saw about what were some of the considerations when you're thinking about the political risk exposure of acquisition or participation into a project like this, like in terms of?
First of all, according to China Going Global Index, Malaysia now ranked #4. #1 is Singapore. #2 is United States. Hong Kong ranks #3. And Malaysia become very popular destination for Chinese overseas investment. Mm-hmm. And I remember I have been in Singapore for almost 5 years now. Mm-hmm. I frequently travel to Kuala Lumpur for few things. High-speed train project. And there is one energy company is acquired by a Shandong Teapot company. Mm-hmm. And when this Chinese company acquiring power assets in Malaysia, Marsh did send our political risk expert in Hong Kong to have a discussion with the Chinese company. I think that's the CEO of a Chinese company, and it's about if Chinese company acquire this Malaysia power assets, what if the PPA, the contract, need to be renegotiated? What if for national security purpose, Malaysia government want to nationalize the assets?
Yep. No, it will never happen.
Yeah,
of course.
but in the end, in the end, the Chinese SOE thought since Premier Li Keqiang and your former Prime Minister Najib was witnessing this contract signing, they don't think it's a big deal.
Yep.
So they didn't do anything.
Yep.
Yeah.
Yep. No, but so it's interesting, right? Because when you talk about political risks, I don't suppose one would rank Malaysia very high on that sort of exposure. For starters, you are looking at the list of countries that Shiwei was sharing, like in the Middle East and whatnot, the emerging countries. But yet, it's a very real consideration. Guess what? All of these projects now are being re-looked at. The likelihood is it won't be cancelled because it's not so easily cancelled, but they're almost certainly going to be renegotiated. What does that mean as a private enterprise that is participating to the construction of that? That's something you definitely have to be aware of, right? Next to Raymond, right? So Raymond, you obviously spend a lot of time with your Chinese clients. You support your SOE clients from China to all over the world. What are you witnessing from your side of things in terms of the maturity of risk management, in terms of you working with your SOE clients, and how is that translating into how they are being involved in these projects of this initiative overseas?
I would say it's in a very early stage that the Chinese company, especially state-owned enterprise, they are now using the very centralized way of risk management. For example, captive is a form of centralized the group's risk management activities. That's why Edward just mentioned we have only 7 captives now in China and in Hong Kong. I would like to share with you some challenges that I encounter when in my daily contact with the SOE or major Chinese companies when they are going overseas. I think there can be in 3 categories. The first one is the culture. In the past, the Chinese company normally they are very big. For example, the company we just mentioned, China Railway, they have 25 branches, and each branch they may have 20, 30,000 employees. So you can imagine the size of the whole China Railway group. So whenever you want to centralize some company policy or procedures, you have to implement all these procedures in, let's say, in 25 branches at the same time. So you can imagine the difficulties. So in the past, I would say most of the Chinese companies, they would use a decentralized approach of risk management. And also the daily management of a company is more like a decentralized type. This is one of the culture. And another culture that you can easily find in Chinese company is that they think that insurance is a requirement. It's not for the risk management. Especially in the overseas projects, overseas investment, insurance is normally requested by the employer or by the owner in the host countries. So the first thing they think about insurance is how much it will cost, instead of what the risk they're going to transfer. So this is the mindset of some, or still the mindset of some of the Chinese companies nowadays. And the second challenge that is the resources. Nowadays, I can find many Chinese companies, they can have projects in 20, 30, or even 50 overseas countries at the same time. So if you are the insurance manager sitting in Beijing or Shanghai, how do you have the resources to handle all these overseas projects at the same time? And also, what experience you can have, like Shiwei mentioned, the local knowledge. This is very important. Each country has its own insurance regulatory framework, its own legal system. So you need to keep all this knowledge update. It's not a simple job. So I don't think that the captive or the centralized risk management team, they can build up this kind of knowledge in a very short period of time without the help of third-party consultants or brokers. And the last challenge is the talent. The insurance industry in China, up to this year, I would say it has about 40 years of experience after the opening of the market, of the insurance market in 1978. So in these 40 years, the China insurance market grew rapidly, and also same as our construction company or engineering company, they grew rapidly. It's not a surprise that you can find some project manager in overseas project. They are maybe just 30 years old, but they are handling a billion worth of project outside China. So as the economy is growing so fast, I would say the talent does not have enough time to become mature and get the required knowledge.
Right, so it sounds to me that there's an opportunity there when you're partnering up with Chinese companies, right? Because they have no shortage of money and people, but there are obviously deficits and shortages in other aspects in terms of expertise, in terms of talent, and that is where, when you're looking to partner up in this sort of initiative, this is where you should be looking to support them, right? And I was just going to pick up a point about the differences in terms of scale and again some of the cultural aspect, because I recall meeting a risk manager from China, and then so we were doing the introduction, and then it's like, so who do you work for? And I'm like, so I work for the International SOS, and by the way, it's a multinational company. Oh, I have 13,000 employees worldwide. I'm a big company. Then she was like, yeah, I'm a risk manager of a small SME in China. I'm just operating in 10 cities. I have about 500,000 employees, but I'm a small SME. So the competition and scale is completely off the charts, right? When they're talking about, when you're positioning yourself as MNC and they are thinking of themselves as just a mid-tier SME, but the numbers are completely bonkers. Right, so I'm going to take questions as well from the app, so please do feel free to give your questions up on it. I can obviously pull out some of the questions on my phone as well. And I think one of the questions that popped out right away that I saw was people are obviously convinced by the political risk exposure, and how should that be structured? Like what would be a typical structure of a BRI infrastructure project to guarantee, to protect the political risk exposure? Like maybe Shiwei or Yiming, you can share a little bit, like what would be the way that you look to firstly look at what is the political risk exposure, and how would you look to protect or finance that risk?
So political risk is a long-term product. So it's not for 1 year, 2 years. Usually you look at multi-years agreed upon at the purchase of the insurance time. So the team itself is very specialized. And I personally know quite well a few underwriters. And you see their background in this either trade credit, so they understand how this individual countries work in the investment arena as well as a financial world. Or they have a politics background. So they understand from international relations perspective how this trade war and how this potential government change would work. Because if you're looking at a project, you have about up to 10 years or even more to construct. Then you also enter into operations. So it's not just you construct and then it's all concluded. Mm-hmm. You will also be carried on for the operational mode. So all of this will need to be analyzed, because in the countries, you might have multiple governments, right? Either elected or being voted against, then you will have those changes. And different government might take different views as well. So I think it's very important to this is why this need to partner with the global or international brokers as well as insurers and reinsurers who has the expertise, who have been doing this and understand the geopolitical risks involved, so that the projects, the investors, as well as locally who is involved in those, will be able to capture the risk fully and construct a particular policy to cover the political risk.
Right. And I guess also it depends on what are you worried about, right? Because are you worried about your assets being seized, Or are you worried about, say, maybe the currency controls or capital controls about being able to take money out of the country? Because then that results in quite different kind of solutions that you're looking at. And I say this from experience, because International SOS operates in 94 countries. So we do business in all sorts of places in the world, and one of the places that comes to mind is Angola, where we have operations there, and our challenge there was actually not about doing business there. It's after you do business, you get paid in Angola, there's no way of getting money out of Angola, which is a problem. So you get paid, your asset is there, your people are there, but your money is trapped there, and your money is not much used there in Angola when you can't get it out of there. So it really depends on what is your key consideration when you look at the political risk consideration, right?
One thing to add to that, as you mentioned Angola,
Yep.
which is very interesting because from political risk perspective, you will need to handle those permit change or potential convertibility and also this exportability. However, if you have a captive, which is involved you have a captive global fronting programs, then the local policy will be issued in Angola on admitted paper. Then you could utilize central premium collection. So your premium would never be paid locally. So that allow you to have that premium and risk exportability to your captive fronter, then to your captives.
Yep. Or the alternative is to send a guy to Angola with 2 bags, and then you try to get the money out, right? So it depends. What is more efficient? Right. So an easy question for Edward. Like 7 captives in China. Where are they domiciled? And I think I will link that with another question there, which is the captive concept, very new in China market. How do you go about doing it? Like what has been the biggest challenge? Like I said, but what have you been doing to promote in terms of what is making the SOE or Chinese companies bite when they consider a captive?
Yes, among the 7 captains in China, 4 of them domiciled in mainland China, and the 3 of them in Hong Kong.
Okay.
Yes.
So still China. So
Still in China.
there are no offshore.
Yeah, still in China.
Captives, right? Okay.
And yes, actually, captive concept is still very, very new in mainland China. And also for the regulator in China, also is a real concept. So they are also found how to oversee captive business in China as well. And for the firm, actually, I don't think the environment in mainland China is very encourageable the Chinese firm to establish their capital in mainland China, because the threshold is still very, very high. But for those Chinese company, they can think other domicile to establish their captive, also using captive as a vehicle to make some self-insurance or to do some risk management.
Right. Okay. So this question probably for Raymond, like the SOE approach to risk, focusing on premium amount instead of the benefits of risk transfer has to do with the fact that it's government that will foot and pay the bill. Is that something that you will concur with? Is that something that you see? Because we were just having this discussion about there are SOEs, there are companies that are partially owned by like SOEs, which then falls into a different category. So you have a SOE partnered with a foreign investor, you have a SOE partnered with a local private investor, wholly owned SOE. Does that make a difference? Does that translate into tangible differences in terms of how these entities will manage their risk?
Well, I think the difference is not that significant. I think the main reason for this kind of observation is because their mindset about the risk management. Maybe they just don't have this kind of a mindset. They need to manage the risk through the insurance, and so they think that price is the main concern when they decide to buy the insurance. And also, I think the other reason is because of the user experience. Maybe in the past, when they bought the insurance from either the overseas country or from China, they may not receive the claims that they should receive. So they think that, paying money to buy insurance is not that worth spending. And they think that it's more or less a kind of meeting the requirement of a contract or requirement by the owner. So price is
So price is still the main consideration. But I would suppose that has changed. Like I've seen some of the risk manager peers in China, but because of the collaboration they have with international peers, there's an aspirational aspect in terms of trying to work to that level of risk management as well. Like are you seeing that in your interaction with the SOEs and the clients that are?
Absolutely.
Yep.
Because when we are talking about Belt and Road initiatives, we can see more and more cooperation with the foreign companies in the host countries. So that will also increase the risk awareness of the Chinese company.
Right.
Yeah.
Do you see that drive coming more internally from more aware, enlightened individuals within SOEs, or do you see that pressure coming more externally? Just because I'm this German corporation, you want to do business with me, this is the level that you need to do. Like what would you say is a bigger?
I would think 50-50.
Okay. Okay. You would like to hedge the fence? That's fine. Right. So this question: How can the BRI affect the insurance market in Malaysia, be it insurer or captive? I'm going to direct this at Yiming, and I guess this is more about what are you seeing when you are following your China outbound clients to the various market and territories that they're operating in. How are you seeing the entrance of your clients into the market, and how is that impacting the local markets that you are interacting in?
Everybody try to get a piece of action.
Yep.
And according to Swiss Re statistics, they are going to generate this amount of premium in property, construction, marine cargo, and also other line of insurance. But from my perspective, I'm dealing with Chinese client, and we, as a broker, we also place the risk with underwriter. Right now, I see more opportunity for Chinese underwriter. Mm-hmm. Because for any large construction infrastructure project, I think a PICC or even a small insurance company, Huatai, they have huge capacity. They can write a project 100%. So last year in Singapore, MAS initiated a so-called Belt and Road Insurance Consortium. And China Re Singapore is the administrator. But we actually, we are struggling because we don't
get any action?
Capacity. China already has the capacity.
Yep.
But I mentioned earlier, for certain line of insurance, DSU, KNR, terrorism, and political risk, yes, China doesn't have capacity. They need international market support. Actually, I quite like this comment about the trade war. Because this is a very high level, and I think we only have 13 minutes.
Please comment.
I just want to add one comment because I study law, and I spend a lot of time studying World Trade Organization. And I remember in Christmas of 1996, I visited the University of Michigan, Ann Arbor, and I met with a professor called Professor Jiang Jackson. He is the leading authority of international trade. So during that time, I asked him a question. I said, why China cannot become a member of the WTO? He told me it's quite simple. WTO is a club. All the market economy, if you are market economy, you can become WTO. And he told me during that time, China is not market economy. That's why China cannot become a WTO member. Mm-hmm. So you all know, I think it's 1999 or year 2000, finally China became a member of the WTO. And you all know this is not bilateral agreement. This is a multilateral organization. And if China and the United States or Canada or Singapore, Malaysia has any trade dispute, you can go to a body called DSB, Dispute Settlement Body. And they have judge, they have arbitrator, they can settle the dispute. And every country should follow the arbitration. Now, my comments is regarding Singapore. I have been living and working in Singapore for 4 years. A lot of people ask me, what is Singapore's role in the Belt and Road Initiative? And one of our Marsh clients comment, Singapore will play a role as a facilitator, and sometimes even even arbitrator. To give you an example, Belt and Road project will be 20 years, those long-term, large infrastructure project, and a dispute will happen. Last week, I was in Singapore attending Baker McKenzie Belt and Road Forum. One lawyer mentioned Singapore can be the ideal place to settle dispute. For example, Singapore International Arbitration Center. And also this gentleman remind me there is another organization called Singapore International Mediation Center.
Yep.
And I heard 80% of the case regarding China, right, has nothing to do with Singapore.
Yep.
But both parties agree they are going to use Singapore arbitration. And according to a New York Convention, arbitration award in Singapore can be easily recognized and enforced in China. So,
yeah, well, like Singapore has shown that we don't need to be involved to be a host, as proven when we hosted Mr. Kim and Mr. Trump. But I think what is interesting as well is that people focus a lot on the infrastructure aspect of the Belt and Road, but what China is doing is also on the softer side. And as part of that initiative, I guess to address the exclusion from clubs like WTO, they are also setting up their own the international dispute courts in Shenzhen and Xi'an, saying that those are the hubs of your new Silk Road, and this is where the disputes that relates to the Silk Road construction should be settled in China that is modeled after international laws. So that's exactly what they're trying to go around as well, and whether Singapore can continue to retain that advantage is debatable as well, right? Because that's what China's grand plans are in terms of the overall narrative. It's not just the infrastructure. Right, so BR scared a few countries, and some people argue it was designed to protect China's soft power, loss of attention. Is the trade war already impacting BR? I don't know. Like, does anyone has an opinion on that? What are you witnessing in terms of the activity? Is it slowing down? Is it picking up? Like, is the slowing down due directly to the trade war, or is that due in general to the overall perception that China's growth is slowing down, overall speaking, which is why they are aggressively expanding overseas to begin with? Like, what are you seeing, like maybe from Raymond or from Edward, from a domestic point of view? Like, is the level of activity, is it increasing? Is it the same? Are you witnessing no change in terms of activity you're seeing from the clients?
Well, I would think that the trade war will not directly impact the BRI, but I think will indirectly affect the investment that the China government can put in the Belt and Road initiatives. And we can see that starting from the beginning of 2018, there's a little bit slowing down of new projects in Belt and Road.
Right. Okay. Like Edward, like any observations on your end on the level of activity you see coming out of China with your clients?
Yes, I think the trade war should have some impact for the Belt and Road initiative. But I think for the first part of the question that probably a little bit not so agreement with our soft power, the influence from China for Belt and Road initiative. Probably we should see the consequence, because during the past 5 years, I think Belt and Road initiative has already been the open and inclusive international cooperation platform, and also I think they have some win-win result from that. So I think we should look at the consequence or the result for this initiative. Right. If all the people or country have the benefit from the initiative, I think it's a good thing. Yeah.
Sure. Okay.
Actually, I think
yes.
This China-US trade war sometimes can benefit countries in Southeast Asia. For example, a lot of Chinese companies now already moving their manufacture center to places like Vietnam, like Cambodia. First of all, for cheaper labor costs. Yep. But sometimes they also try to get a benefit of those trade agreement between, say, like Thailand and the United States. So, for example, if I'm a rubber tire manufacturer, I move from Hangzhou to Bangkok, then I can enjoy some of the...
And given that the US and Australia, like you mentioned, are not part of this BRI initiative, if anything, the trade war is going to expedite the collaboration with the rest of the countries. But I think I just saw this morning that the US and Australia are announcing their own trade deal for the region, and it remains to be seen what actually comes out of that, because that's definitely developed in response to this and then pulling out of the TPP as well, right? I'm going to pick up one last question from here. I have a choice of two. So I'm going to look at the sanctions one, because I think that's an interesting one. So I'm not going to focus it just on K&R policy per se, but it's more from a sanctions point of view, because that obviously comes into play as well when you have multi-state actors being involved in an infrastructure project. As a corporate, how do you deal with complying with all these sanctions? Maybe Shiwei, from an international point of view, you can answer that?
Yeah, sure. From the global insurance perspective, because in general, we tend to subject to various sanctions, either UN, EU, US, and to be full compliant is in the best interest of the client. So this is why when it comes down to the sanctions, then we need to be abide by those rules. However, when it comes to the global programs, because we can provide different solutions, as if a local policy cannot be provided due to sanction reasons, then we can protect the parent company's financial interest of those subject to legal approval. So we have a legal compliance team, for example, just take us. I believe that for our peers, they would have a similar practice. That we have a very responsive legal and a compliance team. They will review in 24 hours. Then they would give us the update on whether we can include that under the financial interest clause. So it's an alternative. It doesn't provide you with the local coverage. However, it indeed can provide you the parent company, your financial interest in that particular country.
Yeah, but it's not a catch-all. And for sanctions, because I work a lot with my group general counsel when it comes to compliance with sanctions, and it's not meant to be black and white, because you cannot be in compliance with every sanction in the world. And ultimately, firstly, it's a cost. When you're working with an insurer, you are thinking about sanctions considerations. There's a cost to be compliant. And then secondly, there is a commercial consideration as well, right? Because where the sanctions can be changed based on the whim of one stupid American who decides to not be participating to Iran, so you reimpose Iran sanctions. So that's very real. That has real implications for people who are doing business on the ground in the country. And that translated into actual difficulties in saying that, okay, we are still going to serve our client. Our client is still going to do business in Iran. What do you do now? So maybe my American insurer is not comfortable, but what about you? Right? Because this is actually a real scenario that I face as the risk manager of a company that deals with all of these aspects. So we have US clients, we have our clients who are traveling to all sorts of sanctioned countries. We are here to provide a service still. Then how do you reconcile that while remaining compliant with a global international program at the same time? So that's something you have to weigh, and it's not a black and white thing, right? Right, so I think I have about 3 minutes left. So I've been tasked by the organizers to make sure that I run a poll for the audience after the panel, which relates back to the BRI. So basically saying how much of an impact do you think the BRI will have on Asia's insurance market? And hopefully the panel has done a decent job of convincing you that there's going to be some impact, if at all. So that's great. So I think this is part of a research that the Lebanon IOC is undertaking in terms of just looking at the impact of this. And there's also a second question as well. So we have 38 and counting, respondees 40. Some impact, big impact, great. Will captives have a role to play in the BRI in the next 5 years? And I guess this is where all the insurers and brokers take a snapshot of this and build your business case for captives for the next 5 years, like in the market, if that's what you want to do, right? Right, so I think that's all I have. So I hope you guys enjoyed the panel, and thanks for the panel, and I hope you find it an enjoyable session. Thank you very much.